Silver explodes to $67. Is $70 the next stop? What just changed in the market? 1. Record-breaking move in silver. Silver delivered one of its most dramatic price moves in modern market history, surging to nearly $67 per ounce in a matter of hours, and setting a new record high. What made this move remarkable was not just the level itself, but the speed, timing, and context in which it occurred. Markets that had appeared uncertain only a day earlier suddenly flipped decisively bullish, leaving many analysts and traders scrambling to reassess their assumptions. In the hours leading up to the breakout, silver was facing skepticism. Technical indicators had begun flashing cautionary signals, momentum appeared to be slowing, and some analysts warned of a potential short-term pullback. Yet silver once again reminded the market of its unique character. Rather than respecting resistance, it overwhelmed it. Instead of consolidating, it accelerated. By the time the U.S. trading session ended, silver had already erased doubts, and once Asian markets opened, the rally intensified. The spot price climbed as high as $66.92, while futures contracts briefly pushed beyond $67, marking a psychological and historical milestone. This was not a marginal new high. It was a decisive break that redefined expectations. Silver did not drift upward, it exploded higher. Daily gains exceeding 4% at such elevated price levels are rare for any major asset, let alone a metal often dismissed as secondary to gold. What stands out most about this move is that it was not driven by a single headline or isolated data release. Instead, it reflected the culmination of multiple pressures that have been building for months: tight physical supply, rising industrial demand, renewed monetary easing expectations, and a growing shift in institutional behavior. Silver's breakout was not random, it was structural. Equally important is the psychological impact of this move. Silver has long been regarded as volatile and unreliable, capable of dramatic rallies followed by brutal reversals. Yet this surge feels different to many market participants. The scale of the move, combined with its persistence across trading sessions, suggests something more than speculative froth. It suggests repricing. Another critical element is timing. This breakout occurred late in the year, when liquidity is often thinner and market positioning more fragile. Moves during such periods tend to reveal underlying stress, rather than speculative enthusiasm. In this case, silver's strength into year-end indicates urgency among buyers rather than complacency. The rally also reignited debate about silver's true role in the financial system. Is it merely a leveraged play on gold, an industrial metal tied to economic cycles, or is it re-emerging as a monetary asset in its own right? This price action forces the market to confront those questions seriously. Assets do not rise over 120% in a single year without challenging established narratives. Ultimately, silver's surge to $67 is not just a number on a chart. It represents a shift in perception. It signals that silver is no longer content to lag behind gold or remain trapped in historical undervaluation. Whether or not $70 is reached in the immediate future, the message is already clear. Silver has entered a new phase and the market is being forced to adapt. 2. Today's market action across precious metals. Silver's explosive rally did not occur in isolation. It unfolded within a broader, powerful advance across the entire precious metals complex, signaling a coordinated shift in market sentiment rather than a one-off anomaly. On this trading day, nearly every major metal finished firmly in the green, but silver stood out as the clear leader, both in percentage gains and narrative impact. Gold posted a solid advance, rising roughly 1% on the day, adding over $40 per ounce. While this move might seem modest compared to silver's surge, it remains significant given gold's size and liquidity. Gold's strength reinforced the notion that safe haven demand is building again, supported by expectations of easier monetary policy and weakening macroeconomic indicators. Platinum delivered another eye-catching performance, climbing more than 3% and briefly pushing toward the $1,900 level. Platinum's resurgence has been one of the quieter but more structurally interesting developments in recent months. Long undervalued relative to both gold and silver, platinum is benefiting from constrained supply, renewed automotive demand, and investor rotation into under-owned assets. Palladium followed closely, rising over 3% as well. Although palladium has struggled in recent years due to shifts in automotive technology, its rally alongside platinum suggests renewed interest in the broader platinum group metals. Even rhodium, one of the most opaque and illiquid metals, joined the rally, climbing toward $8,400 per ounce. This synchronized movement matters. When metals rise together, it signals systemic drivers at work: monetary conditions, geopolitical risk, currency dynamics, rather than isolated supply disruptions. In this case, silver's leadership role is particularly noteworthy. Traditionally, gold leads and silver follows. On this day, silver pulled gold higher, not the other way around. From a market structure perspective, silver's outperformance indicates growing appetite for volatility and leverage within the metals space. Investors often move into silver when confidence increases and risk tolerance rises. The fact that this rotation occurred alongside strength in gold suggests that markets are not choosing between safety and growth. They are hedging for instability while positioning for upside. Another important factor is year-to-date performance. Silver is now up approximately 126% for the year, dwarfing gold's roughly 65% gain. Such divergence underscores silver's re-rating. It is no longer merely responding to gold's moves. It is asserting its own market logic driven by supply constraints and industrial demand. Volume data further confirms the significance of the move. Trading activity surged across futures exchanges, while reports from physical markets indicate heightened interest from both retail and institutional buyers. This combination of financial and physical demand is rare and powerful. Importantly, the rally occurred without signs of panic or disorder. There were no circuit breakers, no extreme dislocations, no visible breakdowns in market functioning. That suggests this was not a short squeeze in the traditional sense, but rather a sustained repricing supported by genuine demand. In short, today's market action paints a clear picture. Precious metals as a group are being repriced higher, with silver at the forefront. This is not a defensive trickle into gold alone. It is a broad-based movement that reflects deeper shifts in how markets view inflation, growth, and monetary stability. 3. Spot versus futures, signals from the physical market. One of the most telling aspects of silver's recent surge lies not in headline prices, but in the relationship between spot and futures markets. As silver approached $67 per ounce, the spread between spot prices and near-dated futures contracts narrowed dramatically, at times nearly disappearing. This convergence is unusual and carries important implications for the physical market. Under normal conditions, futures prices trade at a premium to spot due to storage costs, financing, and time value. When that premium compresses or disappears, it suggests immediate demand for physical metal. In extreme cases, spot prices can exceed futures prices, a condition known as backwardation. While silver has not yet entered persistent backwardation, it has hovered dangerously close. This matters because backwardation in precious metals is rare and disruptive. It indicates that market participants value physical possession today more than contractual delivery in the future. In other words, the metal itself becomes more desirable than paper claims on it. The near parity between spot and futures during this rally suggests tightening physical availability. Buyers are willing to pay up for immediate delivery, while sellers are reluctant or unable to meet demand without higher prices. This dynamic aligns with reports of increased physical accumulation by large institutions and ongoing strain in wholesale bullion markets. It also exposes vulnerabilities in the paper-dominated pricing system. Futures markets are designed to provide liquidity and price discovery, but they rely on confidence that contracts can ultimately be settled. When physical demand overwhelms that confidence, futures pricing loses authority. Silver is particularly sensitive to this phenomenon because of its dual role as both a monetary and industrial metal. Unlike gold, much of silver's supply is consumed and not easily recycled. Industrial demand, from solar panels to electronics, competes directly with investment demand for the same ounces. As prices rise, one might expect supply to respond quickly. Yet silver supply remains constrained. Most silver is produced as a byproduct of other metals, limiting producers' ability to ramp up output in response to price alone. This structural rigidity amplifies pressure when demand surges. Another layer to consider is the behavior of large commercial players. When futures prices no longer provide sufficient incentive to part with physical inventory, dealers reduce selling or raise premiums. This reinforces tightness and accelerates price discovery upward. The implications extend beyond silver. Persistent spot futures compression challenges confidence in derivative markets more broadly. If market participants begin to doubt the availability of physical settlement, risk premiums rise across the system. In this context, silver's rally appears less speculative and more mechanical. It reflects a market grappling with scarcity, not exuberance. The narrowing spread is a warning signal, one that historically precedes sharp price adjustments. Whether or not silver enters sustained backwardation, the message is clear. The physical market is asserting itself. And when physical reality confronts paper pricing, history suggests that prices move higher, not lower. 4. Why technical resistance failed. Silver's latest surge confounded many technical analysts. In the days leading up to the breakout, charts suggested weakening momentum, overbought conditions, and potential resistance near previous highs. Yet when price action unfolded, those levels offered little resistance. Silver simply powered through. This failure of technical resistance highlights a critical truth. Technical analysis works best in balanced markets. When structural forces dominate, such as supply shortages or macro regime shifts, price action can overwhelm traditional indicators. Silver is notorious for this behavior. Its relatively small market size, combined with high leverage in futures trading, makes it prone to sudden repricing. Once momentum turns, moves can become self-reinforcing as shorts cover and sideline buyers rush in. Another factor is positioning. Data suggests that many traders were positioned cautiously or outright bearish following recent consolidation. When silver began moving higher, these positions quickly became untenable. Forced buying accelerated the rally, rendering resistance levels irrelevant. Importantly, the breakout did not occur on thin volume or dubious signals. It was accompanied by strong participation across sessions, confirming validity. This was not a false breakout, it was a regime shift. Technical indicators are backward-looking by nature. They measure past behavior, not emerging constraints. When physical demand tightens and macro conditions change, price can move faster than charts can adapt. Silver's move also underscores the limits of short-term technical forecasting in secular bull markets. During strong uptrends, pullbacks tend to be shallow and resistance zones temporary. Traders waiting for perfect entries are often left behind. In essence, resistance failed because it was no longer relevant. The underlying forces driving silver higher outweighed any historical price memory. When markets reprice assets, they do not ask for permission from trend lines. 5. Institutional and macro catalysts. Behind silver's dramatic price action lies a powerful convergence of institutional behavior and macroeconomic forces. One of the most striking developments is the reported shift by major financial institutions toward physical silver accumulation. When large players move from trading paper exposure to acquiring real metal, it signals conviction. This shift coincides with growing expectations of monetary easing. Weakening labor data, rising unemployment, and downward revisions to job growth have revived expectations for interest rate cuts. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. Markets are forward-looking. Even the anticipation of rate cuts can drive asset repricing. In this case, silver appears to be pricing in not just cuts, but a broader pivot toward accommodative policy. Inflation dynamics also play a role. While headline inflation may fluctuate, structural inflation pressures, from energy to wages, remain unresolved. Precious metals historically perform well in such environments. Institutional rotation is another key factor. As gold becomes crowded and expensive, capital seeks alternatives. Silver offers higher beta, tighter supply, and greater upside potential. Platinum's rally reinforces this rotation theme. Importantly, institutional involvement lends durability to price moves. Retail enthusiasm can spark rallies, but institutional capital sustains them. The current silver rally bears hallmarks of the latter. Geopolitical risk and safe haven demand. Geopolitical tensions have added fuel to silver's rally, reinforcing its role as a safe haven asset. Escalating conflicts, trade disruptions, and sanctions contribute to global uncertainty, prompting investors to seek assets outside the traditional financial system. Recent tensions involving energy supply routes and international sanctions have heightened risk premiums across markets. Precious metals benefit disproportionately from such environments. Silver's advantage lies in its hybrid nature. It offers safe haven characteristics similar to gold, while also benefiting from industrial demand. This duality makes it particularly attractive during periods of geopolitical stress. As uncertainty rises, diversification becomes paramount. Silver's liquidity and global recognition make it a natural hedge. 7. Gold-silver ratio and upside potential. The gold-silver ratio, now near 65, has compressed significantly, signaling silver's outperformance. Historically, ratios between 55 and 65 are considered normal during balanced markets. Given silver's industrial demand and supply constraints, further compression remains possible. If gold holds steady while silver rises, the ratio could move toward the lower end of historical norms. This suggests meaningful upside remains. Ratio analysis does not predict timing, but it provides context. Silver is no longer deeply undervalued relative to gold, yet it is not expensive either. In secular bull markets, ratios often overshoot. That possibility cannot be dismissed. Volatility $70 target and investor strategy. Silver's volatility is both its greatest risk and greatest opportunity. Moves of this magnitude inevitably raise questions about sustainability and strategy. The $70 level is now a logical short-term target, driven by momentum and sentiment. Reaching it would not require extraordinary conditions, just continuation of current trends. However, volatility cuts both ways. Sharp pullbacks are always possible. Investors must balance conviction with discipline. A common approach is maintaining a core position, a permanent stack, while tactically managing excess exposure. This allows participation without emotional decision-making. Ultimately, silver's rally is redefining its value proposition. Whether prices pause or push higher, silver has already sent a powerful message. It is no longer ignored, underestimated, or dormant.